All right, welcome everyone. This is our bootcamp drill number 5. Thank you for tuning in on an ad hoc schedule on Thursday. So this was a session that we wanted to cover in drill number 4, but we did not have enough time because we had some good discussions around entry criteria for option trades, which is the most important step. So I didn't want to cut that short. And thank you for agreeing to meet today. So today we're going to talk about an option strategy called vertical spreads, or sometimes just spreads. And this is a strategy that we can use for small value accounts. Mostly, if you are just a cash account, don't have margin available. So how do we trade on stocks like Amazon? Amazon is like 3,000 plus stock. So there are some strategies that we can use. We can make use of spreads, and that's what we're going to discuss today. Before we start, please note that all that we're going to discuss today is only for your education. It's not an investment, financial, or tax advice. I'm not a registered or licensed tax or financial professional. So take it up as an education, learn from my experience. I learn from your experience. Maybe we have a little bit of fun as we go along, but that's all it should be. So let's move on. Small value account. So what do I define as a small value account? Right. Generally, it is an account less than $25,000 because you don't have a margin available from your broker. Now, it could depend from broker to broker firm. TD Ameritrade used to have a $25,000 limit. So if you have $25,000, your net liquid, they will give you a margin. Otherwise, it's a cash account. So using that as a barometer, that's why I'm saying $25,000 or less means it's a small value account. It's primarily a cash account. Now, cash account means that you don't have access to margin. So if you are buying or selling, you have to pay full amount upfront. An example, if I'm buying a stock of XYZ and it's a cash account, XYZ is at $50. If I'm buying 100 shares, then I have to pay $5,000. So if I had $25,000 account, then I can only trade for $20,000 more because $5,000 has already been consumed in buying 100 shares of XYZ at $50 each. But if I have a margin account, and then normally the stocks are 50% margin. So if I buy the same stock, XYZ, whose price is 50, it's only $2,500 will be blocked. So I will still have 22,250, whatever that math is. What's happening? Yeah, $22,500 available. For a moment, I kind of blanked out on my math. I was never great at maths anyways. I hope my dad is not in this one. So that's what a margin is. So primarily, we're talking about small value account means you don't have access to margin, so you have to put up everything upfront. This also applies to if you have an IRA account. IRA is primarily a cash account. So even if you have more than $50,000, $100,000, if you are doing options in IRA account, it is treated as a cash account. You have to put up all the money upfront. So now if you have these accounts, there are certain things that we can do. For example, we cannot send naked call. Why? Because naked calls theoretically, they have unlimited risk. Let me bring up the broker platform and let's discuss that. Let's pick up a stock, JP Morgan, JPM. So if I want to sell a call, and again, I'm not saying that you should do it. If you are a just getting started into options, you should never sell a naked call. But say, just for discussion's sake, I want to sell a call on this one, and I sell a call at 140. I sell at the money call. Now, in theory, this trade has got unlimited risk. Why? Because stock could potentially go up to infinity. Doesn't happen in practice, but in theory, it could. So right now it is at 135. I sold a call at 140. I received a premium of $3.40. So I have a buffer till $143.40. Now beyond that, my account will start to lose money because it's a naked call. It's not covered. So as the stock continues to rise, I continue to lose money. So you cannot do naked calls, or you cannot sell call if you have a small value account, because then you have theoretically you have an unlimited risk. Naked put or cash secured put, it have a huge risk, right? It does not have an unlimited risk, but still the amount of risk is big. Stock could actually go to zero, right? So for example, if instead of selling call, if I was say bullish on JP Morgan, so instead of selling call, I'm going to sell a put. I received $7.40 as a premium. So let's do, it's an 135. Stock is at 135. I sell 135 at the money put. I received $4.65 as a premium. And I'm bullish on JP Morgan. So I sold this put, assuming, JP Morgan will go high. Even if it doesn't move in my direction, I still have $4.65 of buffer. So stock is currently at 136. And I sold an at the money put, short put at 135 and have collected $4.65. So even if my direction sense is wrong and a stock goes low, I still have some buffer. But a stock could go to 110. This expiration is still 43 days away. Anything can happen between now and February 19th. So it's not an unlimited risk, but still I have a risk. The maximum risk in this case would be that the stock could go to zero. In that case, I will lose all $13,000, $13,500. That's the maximum risk. Other thing is both will consume huge buying power. If you're doing a naked call, the amount of money that your brokerage will block is huge. So first of all, if you're just starting and you have the lowest level of privilege, you won't be even allowed to do a naked call. Naked calls are allowed only in the highest level of privilege because there is a potentially unlimited risk. But you are allowed to do a cash secured put, which is your naked put. But in this case, if you are bullish on JP Morgan, and if you want to play JP Morgan, and if you want to do this trade, it will block $13,500 for this trade. Now, if your overall value, portfolio value, overall cash you have is only $20,000, then you're stuck. You did one trade, which now, if you recall the trade entry criteria that we discussed yesterday, this is too big for your portfolio size. So now I'm saying you can't participate in JP Morgan's stock. If it goes higher, you kind of lugged out of it. But this is too big for your position size. Because it does consume huge buying power. And I talked about IRA accounts. Naked calls are not even allowed in IRA accounts in most of the brokerage firms. There are some brokerage firms who know how to manage risk really well. So they do allow you to do naked calls, even in IRA. Otherwise, most of the traditional brokerage firms like Fidelities, etc., even if you may have $200,000 in your IRA, the naked calls is not even allowed there. Again, we looked at an example of JP Morgan. Instead of JP Morgan, if you want to participate in growth of Amazon and you want to do a bullish trade on Amazon by selling a put, you will need to have $300,000 account to just sell one put at the money put. So these trades, if we want to do, if we want to trade in JP Morgan, if we want to take or sell calls or on IRA, you're not allowed to do it. If you have a small value account, you want to trade in big ticker stocks, you can do it. All those trades are not suitable for small account value. So what do you do in that case? That's where we want to talk about spreads. So let's discuss what a spread is. So spread trade is a combination of selling an option, which we have been talking about for now 4 sessions. Sell a put, sell a call. We talked about cash secured put, in which if you sell a put, the whole amount gets blocked. And then we also talked about covered call, means you have a stock and then you sell a call against it. Now, when you're doing a spread, you are selling an option, say you are selling a put as well as buying a put, both together, preferably in a single trade. That should be 100% of the time. I can't conceive of any broker platform who is not allowing you to do this trade in a single leg. And you should stay away from those platforms. So this is a combination of selling an option and buying an option. Both have the same expiration period. So if we are selling an option, selling a put option for 19th Feb expiration period, you should also buy an option for 19th Feb expiration period. The reason is, and we'll look into more examples of it, but the spreads reduces the maximum loss, but there is always a trade-off. It also lowers your maximum profit. So in this case, if you want to play in Amazon, yeah, you would be able to play in Amazon, but you would not be able to make, as much money as someone who has done a naked put. But even with a small value account, you can still play in Amazon, right? Because it reduces the maximum loss. It reduces the amount of buying power that you need in your account. But the trade-off is you will make less money, but you can participate in it. Yeah, it reduces the buying power that's also needed. This is also known as a vertical spread. Because if you look at the option chain, the strike prices are aligned vertically, and that is why it is called vertical spread. So let's take a quick example. We are looking at JP Morgan. Now, this is the trade. I am bullish on JP Morgan. JP Morgan is at 136. I'm selling the closest at the money put at 135 short put. This is my IRA account. Oops, it's consuming $13,500. Too big. So I sold this put. Let's look at how to buy a put. So say I go ahead and buy, now I buy this put. So now if I combine both of them, sell a put 135, bought a put at 110. Look at the maximum amount of money that is being blocked. It is $2,500. For my account, which is $25,000, this is 10%. Not ideal, but not too bad also. fine, 10%, I think I can do this. So now this allows me an ability to participate in growth of JP Morgan share. I'm not locked out of it. So these are two separate trades. So let's see how to do it in a single one. So generally on TD Ameritrade, I'll do is I'll sell 135 and then I buy 110. It automatically understands that this is a vertical spread. It will change here to vertical. Everything looks good. 436. So now let's look at what did I have to give up for doing this trade. So if I had not done the spread, if I had done this naked put, I was getting a premium of $4.65, means $465 of premium. But the amount of money that is being blocked is $13,500. Instead, if I did a spread, I have to give up some amount on my maximum profit. Now I can make only $436. But look at the cost. Only $2,500 is now blocked for this, because that is my maximum risk in this. So maximum loss in this trade, if JP Morgan goes to 0, your maximum loss would be a 2,500 minus $436, which is $2,064. So that's the beauty of doing spread. This is just one example. So you should fire up your trading platform. Again, like we did in a last session, let's do a little hands-on on spreads. And there was one question in previous session around around mini options. And I had asked to hold off your question because you don't need to trade in mini options. And there are, I have never traded any mini options in my life. That doesn't mean we shouldn't, especially I think the mini options are very few. You have on e-mini options. So the most of the stocks that I trade in, not the ETFs, not the indices, but the equity stocks, they don't have mini options. So if I want to trade in Amazon, there is no mini option for Amazon. If I want to trade in Facebook, there is no mini option for Facebook. So what I do? Use spreads. So if you want to trade with the small value accounts, start by using spreads. All right, so let's look at a short put spread. I see a question. Can you buy call against a put for a vertical spread? Then it is not a vertical spread. So when we are talking about spread, both the option type in a spread has to be the same. Either both are calls or both are puts. So let's take an example of a short put spread. So in a short put spread, you short a put means you sell a put. So when you sell a put, the strike, that would be, if you're selling a put, it means you could be assigned the stock at that strike price. If a stock goes below your strike price at expiration, you will be assigned the stock. So you'll have to buy the stock at that price. Now you add a long put in it, means you go and buy a put. Example, this JP Morgan trade we did. I short a put at 135, means I gave someone a right to sell the share to me at 135. And then I bought a put. It means, what if stock goes to 100 or 80? I bought a right to put or to sell the share at 110 because that is my long put. So it means that's how I limit my risk, because if stock goes 80, I will be assigned at 135. But then I bought a put at 110, means I can sell it to someone at 110. So I have no risk below 110. So that is why if you see here, even if stock goes to 80, my risk is limited to $2,064. So when you're doing a short put spread, the strike price of short put is higher than the long put. Means if you're going here, if you're doing short put spread, then you you sell a put, and then you go and buy a put at a strike price which is lower than where you have sold it. You make money when stock goes up? Yes. So when you're selling a put, you make money when the stock goes up. Even if stock goes down, but not by a huge amount, you still make some money. Yes, we limit our loss in this strategy as well. All right, so let's take an example. So you should open up your trading platform. I showed you an example of JP Morgan. Please create a short put spread order for Amazon with the strike prices of $3,100 and $3,090 for February 19 expiration. Go ahead, play along with me. So this is how you can also participate in a big ticker like Amazon. So let's do that. Let's go to Amazon. So Amazon, we gotta do 3,100, 3,090. So now Amazon is at 3,170. Looks like after hours it moved a bit. So it's 3,170. And I'm not as bullish, extremely bullish on Amazon. So I want to give myself a little more room for errors. I'll go to 3,100. I sold a put at 3,100. Now I'm buying a put at 3,090. So this is my put spread on Amazon. I'm bullish on Amazon, but I'm a little afraid that it could fall down, of $100 between now and then, but probably not more than that. So I'm giving myself a little room for error. So this becomes my trade. So I already have one, so I can delete this. So this is my Amazon trade, 3,100, 3,090. If I were to just do a naked put on Amazon at 3,100, I wouldn't be allowed to do it in a small value account, because if we just do a naked put, ignore everything else, it will need $310,000. If I send this trade, it will be rejected because I don't have enough buying power availability in my account. So I can't participate if Amazon continues to rise, or if Amazon stays here, or even if it falls down. The strategy will benefit, but I will need to have $310,000. So instead of doing this, because I don't have that much amount of money, I'll sell 3,100, but I'll go ahead and buy a 3,090 put. Of course, my amount of money that I can make now is close to $447. But my risk, or the amount of money which is blocked, is also $1,000. So I hope you were able to do this trade and understood the mechanics of how to do on your trading platform. So let's look at the other one, which is long put spread. So short put is a bullish strategy. And now if you want to play along with high value tickers, in that case you could use spreads. Now the maximum amount of capital that get blocked in this is equal to the width of the spread. So width means the difference between the two strike prices. Going back to our Amazon example, the difference between these two strike prices is $10. Now you multiply 10 by 100 because each contract has got 100 underlines in it. So that becomes 1,000. So that is the amount of capital that will be blocked for doing this trade. Now, if you have a $25,000 account, oh, this is perfect. This is not too big position for this. So you could still do that even in $25,000 account. I'm not suggesting that you should do this particular strikes. So there are other ways when we want to look at which strike price should I choose. But the idea is if you want to only risk $1,000, you can risk 1,000 and have a chance to make $450. Or if you want to increase your exposure, you could widen the width of your spread, or you could make close to $880. But now the amount of money that get blocked, or the amount of risk or amount of maximum loss that you can have in this trade, if Amazon starts to go down, has also increased. No free lunch. If there is a reward is more, then somewhere the risk is more. Sometimes it may not be apparent, but in this case, you clearly see that the risk is more and the amount of a capital that is blocked is more. Okay, any questions? It's a question says, if stock goes down, you do get stock assigned. In this case, yes, you will get it assigned at 3,100, but then you can also sell it to, you can also exercise your long put option to sell it at 3,090. That is why your maximum risk is limited to the width of the spread minus the amount of premium which you've already received. Right? Okay, so long put spread. So this one, what we looked at was a short put spread, means you're selling a put spread. Now, let's also look at the other side, which is a long put spread in which you're buying a put spread. Now, I'm not suggesting that you should do this. So in today's session, we're not talking about what the right strategy is. All we are trying to understand is the components of the strategy and how to use it. Now, when to use it, separate discussion. So let's look at long put spread. In this case, you buy a put and then you sell a put at a lower price. Let's go back to Amazon example. We had this put spread. If I switch it, instead of, okay, let me maybe do it here on the screen. So now if I want to do a long put spread, so I buy a put at 100 and then I sell a put at a lower strike price at 39. So this becomes vertical. This is put. This is a put spread. Now, when you buy a put, you have to pay out of your pocket. So many people use buying a put as a strategy to hedge. So if you are seeing Amazon, forget Amazon, Tesla. Nothing can beat Tesla in the parabolic moves. So let's look at Tesla. People are glued to the screen saying, oh, Tesla's gone too much too soon. Let's buy a put on Tesla. So if you buy a put on Tesla, Tesla is what, close to 820. After hours, it moved a little bit. So say it's 825. If you buy a put at 825, you need to pay $8,900 out of your pocket right now. If you send it you need to pay $8,900. But this will protect you if Tesla keeps going down to zero. But you don't want to pay $8,900 to begin with. So instead of buying just a put, you can buy a put spread. Means you buy a put, and then you go down and sell a put at a lower strike price. Now, as we saw in a short put spread, again here, your maximum profit, because now you bought a put, your maximum profit is limited to the difference between the strike prices, subtract the premium that you have to pay upfront. So let's look how this looks like. So you were bearish on Tesla, you bought a put, but you didn't want to pay $8,900. So instead of that, you bought a put spread in which you had to pay only $1,400. And you got a protection if Tesla falls below 825, and you have a protection all the way till 800. So if Tesla continues to fall lower than 800, your maximum profit is limited to up to 800. So if you are trying to buy some protections and you find it is very expensive, and if you know that Tesla will fall, but probably won't go below, say, 700. So you could instead buy this, and instead of paying $8,900, you would pay $5,600. So this is a put spread, and some people use it for hedging purposes. Means they'll buy a put on SPY because if market goes down, that put will help, but then you're paying a high premium to buy that protection. So this is one way to lower the amount of a premium that you are paying. But of course, you're also limiting the amount of protection you are getting. Again, no free lunch in any trade, but it'll give you some protection. So if you have a Tesla, you're getting little bearish about Tesla, getting little nervous about Tesla, want to buy a put. Buying a put cost a lot of premium, maybe buy a put spread. Okay. All right, any other questions? So this I already answered. This is a bullish strategy. That was, I think, for a short put spread. Yes, short put spread is a bullish strategy. Long put spread, it helps if the stock goes down. I won't say it is a bearish strategy because I don't know what else you have in your portfolio. If you are holding 100 shares of Tesla and you have done this long put spread, I wouldn't call you a bearish, that you are bearish on Tesla. I think you still want Tesla to go higher. So I wouldn't say long put spread is a bearish strategy. It depends on what else you have in your portfolio. If I don't have any Tesla and I still went ahead and bought this put spread, then I'm bear. But if you have done the same trade, but you hold Tesla shares, then it's not a bearish strategy. That is why when you're dealing in options, you have to double click to understand why the trade has been done. You and I doing the same trade could have a different outlook towards the stock. In a stock world, that is generally not the case. So if you are buying a stock, if you're buying a share and I'm buying a share, we both are bullish. There are no two ways about it. But in an options, we could have a different outlook, even though we are doing exactly the same trade. Like I explained in Tesla. So let's do a put spread example on SPY. Now open up your trading platform and maybe buy some protection. S&P 500 is at 380. Is it too quick, too soon? Who knows? But if you feel it is too quick, too soon, and you think it will go down, and your rest of your portfolio is long, and you want to protect something, if market goes down, you don't want to sell the shares that you own, because that will involve your capital gain tax and all that stuff. And you don't want to part with those shares because those are also giving a nice dividend. So what you could do is, buy a put spread. Again, this is not what I generally do, because buying a put is super expensive. So buying put spread, I don't do for my hedging, but separate discussion on the hedging stuff. But this is one area wherein I bought this protection on put, and I'm paying what, $380 if it goes down below 380. I am protected all the way till 360. If it falls below 360, I don't have any further protection below 360. I have protection all the way up to 360. All right, any questions on put spread, short or long, before we move on to call spread? Okay, well, let's move on. So similarly, instead of a put, what portion you want me to explain again, Naresh? You let me know. Yeah, so again, buying a put for protection is one strategy that a lot of new option traders do. Because if you buy a put, it means you can sell that stock. You have a right to sell the stock at that strike price. So if you buy a put on SPY, so if I'm buying a put on SPY, I have to pay $9.39 upfront. And I'm saying for getting protection for 43 days, paying $9 for $380 stock is too much. So instead of just buying a put, I could go ahead and buy a put spread, which is 380, and I could buy 380 put, sell a 380 put, and reduce my initial outgo to $3 and get myself protection for a $20 fall in S&P 500 for next 43 days. Because my expectation is it won't fall more than $20, or say, sorry, $10. If I want to protect all the way up to $20, then I'll pay a little more for protection. Now I'm protected for fall up to $20. Okay. All right, let's move on to the call spread. Like we had talked on the put side, similarly, things on the call side. If you're selling a short call spread, means you're selling a call spread. In that case, you sell a call at a strike price. Then you go further down or further higher strike price and you buy a call. So let's take an example here. Yeah, the strike price of a short call. So let's take an example on SPY itself. If I have to sell a call spread here, I'll sell a call. Then I'll go further down. Let's keep it at 380 round figures. And then I'll go further down and I buy a call. So this becomes my selling a call spread or short call spread. Let's do a call spread on AI, which is C3 AI, newly IPO company, 135, 150. And then I'll also explain where we can use this. So 130, 150, because say I don't have any shares of AI. And now I'm thinking it jumped up 18%. Oh, I think it's too much too soon. It will fall down. So I'll sell a call here, but I can do naked call. So instead of doing a naked call, I'll do a call spread. I sell a call here, 135 and 150. So I get $4.90. Means if AI stays below 135, I've made $4.90. So this is an example of a selling a call spread. This is because I don't have any shares of AI. This is a bearish strategy for me. I'm bear on AI. This will profit if AI goes low. If AI starts to rise, I start to lose money, but my loss is protected beyond $150 because I bought a call at 150. Again, let's understand, the basic call definition, right? If you are selling a call, means you are giving someone else a right for them to get the shares from you, to call the shares from you. And if you're buying a call, you're getting a right to buy the call. So if the stock goes to 180, whoever has sold a call, you will be assigned a call at 135. You will have to buy from a market at 180 if you don't have the shares and sell it at 135. But then you will also exercise this call, which will allow you to buy, instead of buying at 180, you will basically buy at 150 and deliver it at 135. That's why your maximum loss is limited to the width of the spread, which is $15. So it gives you protection in case the stock continues to go against you. So if you just short a stock, in that case, you have an unlimited loss. But if you do a call spread, then you're limiting your maximum loss. I see a question. A spread, you will have to use market price, correct? If you use limit, you might be able to buy the put, might not be able to sell the put at the same time. No, I never use market price in option trading. Only time I use market price is if I'm doing stock. Whether it's a spread, whether it's a single option, you should always use limit price. And if your trading platform does not allow you to set up a limit price for a spread, I would say find a new broker. So you can always set a limit price. I never do option trade on market price. I learned my lesson. It was my second week of option trading years ago, wherein I lost $500, $600 because I had just moved from stock and I'm like, my trade wasn't getting filled on limit price. I tried 2 times. Then I was like, what the heck? Let's do market. And then I sold it at very cheap rate. And then I had to buy it back. And I realized I made a mistake. Well, that's fun. $500 I would say is a very reasonable amount of money to learn the lesson for a life. So you don't do that. I'm telling you upfront, always use limit price, please. So I see a question. So I'm not going to talk about in terms of when to use these strategies. So for now, let's focus on the mechanics of the strategy. Yeah. And then later on, we can talk about when to use what. So we looked at this. Now where do you use this? And I found this really useful when you're doing a covered calls. So we talked about one strategy called covered calls as a newbie option strategy in which we can generate consistent income by selling call against the shares that we hold in our portfolio. Because if we know, if I bought, let's say AI, I have AI in my portfolio. And if I have to do a covered call, I can go ahead and sell a call at say 180. AI is at 135 for now. And I own 100 shares. I don't want to give away my shares, but I also want to generate some income and make some money out of the shares which I'm holding in my portfolio. So if you have employee stock options, you don't want to give it away, you don't want to sell it, but you want to generate some money, I can go ahead and sell a call at 180 and get some $4.40. But now the shares like AI, shares like Tesla, shares like Airbnb, these all are momentum stocks. For now, it looks like when you're looking at 180 at a strike price and you're getting $4.40 or say 450, you're still making, your net price at which it'll get sold will be like 180, 450 because you got a premium of 450 upfront. Today, you might be thinking, if my share get called away and my net price at which I'm selling it at 184, I think it's a decent price point. I'll go ahead and do this trade. But believe me, the moment AI starts to go higher, you will start to have a seller remorse. And many of my friends had that seller remorse in 2020. I had it. I never knew that 2020 will be what it turned out to be. So instead of doing and selling a simple, just a naked call and limiting your upside to 180, do a call spread. So that if AI becomes crazy and go to 250, you are not locked out at 180. Let's look at an example. So say I hold 100 shares of AI. Okay, I bought it at $100. I own 100 shares. Now, the example I gave for just selling a covered call, it means my portfolio will benefit, but my benefit is limited beyond 180 because I sold a call at 180. So my maximum profit in my portfolio with $100 of stock and a covered call or a short call at 180 is limited to 8,440. I don't want to limit my eventual profit, but I also don't want to sit idle and not have my shares earn anything. So instead of doing a naked call, I would do a call spread in which I sold 180 call and I bought 190 call. In that case, I will ride all the upside till 180. Then my upside is capped from 180 to 190. But if AI shares become super crazy and go to 250, I will still ride it. Okay. But in this case, you are generating very little amount of premium. So maybe instead of 190, I could do 200 or say 210. Then I don't have a additional upside between 100 and 210. But if it continues to go higher beyond 210, I will still be able to participate. But if it doesn't reach 180, I have reduced my cost basis by another 2%. So that's where this call spread is useful so that you don't have buyer remorse. So it has happened in 2020, wherein when I initially put a trade, I've gone far out, 60% or 70% upside and then sold a call. But stock just went to that price. If you have a Tesla, it would have happened multiple times. I don't have Tesla, I'm bear on Tesla. But in any case, so in that case, instead of selling a naked call, sell a call spread so that you don't have buyer remorse. Your intent is to just collect some income. Your intent is not that you hate a stock and you want to let the stock go. You still want to hold the stock, want to ride for next, however, few years. And it is a momentum stock and it goes too high too soon. Sometimes in that case, use call spread. So we already talked about short call spread. Let's look at a question. What if it goes to 185 on expiration date? If it is one penny in the money, then it will be exercised on 185. Means your stock will be called away at 185. So we can talk about it. In that case, you could just close it because the premium will be so low. You still want to retain the stock, just close that leg. Okay, let's look at long call spread, opposite of short call spread. So we did a short call spread in which you are holding a stock and you're doing a covered call a trade, but you don't want to limit your upside because stock is a momentum stock, could go up 100% in next 43 days. Who knows? Can happen. So you don't want to limit your upside, so you do a call spread. Now let's look at an example of long call spread. In a long call spread, you are buying a call and then you are also selling a call. Only difference is your short call is higher than your long call. Okay, so let's look at a long call spread. I probably will have an example here. Okay, let's do an Amazon. 3,300, 3,350. So Amazon 3,300, 3,350. We are doing a long call spread. Now, in this case, again, I'm not recommending this trade. In this case, your long call spread means you're buying a call spread. Many new option traders are familiar with buying a call because they, the whole idea is if you think you're bullish on Amazon, buy a call. But now you go ahead and buy, little bit out of money call. Even if you buy 3,300 call, it'll cost you $105. That is too much, almost $10,000. You're bullish on Amazon, but $10,000 is too much to pay. So instead of doing 3,300, you could, instead of buying just a call, you could buy a call spread in which you limit your maximum upside, but then you have to pay less. So instead of doing 3,300, say 3,300, buy a call at 3,300, sell a call at 3,350. Now you have to pay only $1,500, $1,600 instead of paying $10,000. But in this case, you have also limited your upside. You have limited your upside to maximum $3,000 is what you can make. So this is an example of a long call spread. So if you want to, swing for the fences and you want to take a pot shot on Amazon, continue to go higher, but you don't want to pay $10,000 to buy a call at 3,300, you could buy a call spread. Now, if you think that Amazon could go higher than 3,350, it could go to, but it would go to, let's say, maximum 3,400. Then do a 3,400. Buy a 3,400 call spread. Again, I'm not suggesting that if you are bullish, you should buy a call or call spread. But if you want to do it, I don't do it, but if you want to do it and you can't pay $10,000, maybe buy a call spread. In this case, your maximum outgo will be $3,000. Okay. Yeah, in which you can still swing for fences without paying through nose. You limit your maximum amount of money that you are spending if you're buying a call spread. Okay. Now let's look at some of the other names with which these strategies are known, because if you're reading through it, you might hear these terms, and I'll quickly go through this. Bull put spread means selling a put spread. The way to understand these things is you are a bull means you are a bullish. When you are a bull, when you're a bullish, what do? You sell a put spread. If you're a bearish, then you buy a put spread. Now, put credit spread means you have sold a put spread, but you received a credit. When do you receive a credit? When you're selling something. So if you're reading a term put credit spread, it means you're selling a put spread. Put debit spread, you have to pay money to do this trade. When do we pay money? When we are buying anything. So it means I'm buying a put spread. Short put spread, long put spread, we already talked about. Same is the case with the call. Bull call spread means I'm buying a call spread. Bear call spread, I'm selling a call spread. Call credit spread means I'm selling, because when you sell, you receive a credit, you receive money. Now, some of the things that we need to be aware of if you are doing spreads. When you are trying to manage your trade, and again, we'll talk about trade management in subsequent sessions, but if you are doing spreads, management techniques are very difficult to apply in case of spreads. So if you have to roll the spreads to a new cycle, it's a challenge. So generally, the idea is if you are doing a spread, we already know what is the maximum loss I can have. And if I'm ready to take that loss, then there's no need to manage. When do we manage? When we have an unlimited loss, potential unlimited loss situation. In those cases, we manage it. In this case, there is no need to manage because I already know what my maximum loss is. And if I'm not comfortable with that maximum loss, maybe I shouldn't have done the spread. So when you're trying to manage it, and if you're having a spread, it is difficult to manage. I won't say it is impossible, but you don't always get the optimal pricing when you're trying to manage a spread, when you're trying to roll the spread. Yeah. And if you're using trading in non-liquid stocks, you will see some funny pricing on the spreads. So you might have to be satisfied with a lower premium if you are selling a spread, or you may have to pay higher than the mid price if you are buying the spread. Because by law, if you are selling a single option, the brokerage firm by law is forced to give you NBBO pricing, which is national best bid ask offer, something like that. It means they show you what's the best pricing across all the exchanges. But if you're doing a spread, then it doesn't apply. So that is why you might see some funky pricing if you're trying to do spreads. Very important. I've been telling for almost 50 minutes that the maximum risk on the spread is limited, but you have to be careful. If you are doing a spread, you better close a spread before expiration. Otherwise, monitor it till 2:30 p.m. PST, even after market close. Don't assume that you have a long, say you sold a put spread, you have a long put, and on an expiration date, you went out for lunch, the stock was higher than your short put price, and you thought you won't get assigned. But things change. And in next 10 minutes, I'm going to show you a story, a real example of how a trader thought that his maximum loss is limited and still lost a lot more. So close the spread before expiration. Otherwise, you need to watch it. It doesn't happen always, but there is one case which I came across. I thought it is important that I share that with you. Okay, so vertical spreads limit the maximum risk loss in trade, lesser buying power, margin required is limited, but also your profitability is limited. Okay? And good thing is it is allowed in IRA accounts. You cannot do naked calls, but you can do a call spread on IRA accounts as well. All right, any question? Otherwise, next 5-10 minutes, I'll tell you how a rookie lost $30,000 on a $1 white spread. Again, rookie mistakes. So spreads, they have a maximum risk. Your maximum risk is capped only up to expiration. But now, because of how the stock exchanges operate, there is a time period wherein if you're not careful and if you not closed your spread before expiration and you are not watching the stock after the market close, strange things can happen. And this has happened with one person. So it's been kind of a doing rounds in an option trading world. So I wanted to share that with you so that if you are doing it, you know what the risk involved. Important thing to understand is the option exercise cutoff time. Their cutoff time is 4:30 p.m. Central Time, means 2:30 p.m. Pacific Time for receiving an exercise notice. So 1 p.m. market closes, 1 p.m. Pacific Time market closes. And you are assuming that, oh, my put spread expired out of money because market is closed. But stock continue to trade after hours. And exchanges have a cutoff time of till 2:30 p.m. Pacific. So if you have sold an option that you have not closed, it is still open. And if the stock in after hour time goes below your strike price, in case it is a put option, it goes below your strike price, you are still at a risk of assignment. Brokerage firms might have a little earlier cutoff that you have to check with your brokerage firm in terms of if you want to exercise, what time do you need to notify and exercise your option. So let's look at what happened with this rookie trader. Stock was Tesla. These things happen only in Tesla. Tesla is a millionaire maker stock as well as widow maker stocks. People have lost money, people have made money on Tesla. The trader had a trade for expiration date of September 4, 2020. And this was his position. Short 410.49 put spread means you are selling a put at $410 and buying a put at $409. So as we looked at in a earlier, in this case, ideally, Tesla, because this was September. So now, of course, the pricing is completely different. But if I just frame the trade, 410 for 409, I don't even have that pricing here. Okay, can you? But you understand, this is just a $1 white spread. He did 5 contracts of it. So the width of the spread is $1. Maximum loss, theoretical loss in one contract is $500 or is $100. And he did 5 contracts. So maximum loss will be $500. So which is okay. He was okay to lose $500. His portfolio was capable of the maximum loss of $500. On September 4, which was a Friday, expiration Friday, the Tesla closed at $418. His short put was at $410. It means he will not be assigned. The put spread is fully out of money. It won't be assigned. So it should expire worthless, and then we don't have to worry about it. But for a stock like Tesla, which is very volatile, you still need to worry about it till the expiration time, till the exercise time, which is 2:30 p.m. Pacific. So what happened in this case with Tesla on September 4th? I had to go back and get this data. At closing time, which is here, the stock was at 418. All good. Stock moved up after closing. And then suddenly at 2:15 p.m. Pacific, stock fell down. It collapsed below 410. So the buyer of 410 put exercised its right. So this unfortunate trader was assigned Tesla shares at 410. Remember, the exercise time is at 2:30 p.m. Pacific. So if that trader had gone out for lunch thinking market is closed, Tesla closed at 418, I don't have to worry anything about it. Now, his stock in his account, he had to buy 500 shares of Tesla, each at a price of $410. So this is what happened. This was the position. 1 p.m. Pacific market closed. 2:15 Pacific, Tesla share tanked to 393. So the 410 put is in the money, is assigned 5 contracts. So 500 shares were purchased at a price of 410. Later in the day, when this happened, the brokerage notified the trader saying, you got an assignment. But notification came later after 2:30 p.m. So the 409 long put, the protection that he had, it had expired by 2:30 p.m. And so he had no protection left. Remember, the maximum risk was limited because he had a protection leg at 409. But now, the exercise time, 2:30 p.m. was passed. He didn't exercise and the protection was not used. So next day when he woke, not next day, when the next trading day, when the stock opened, it opened at close to 350. Tesla stock to open at 350. Now, his account size wasn't big enough to hold 500 shares of Tesla. So broker liquidated, basically sold all the Tesla shares at 350. So they liquidated his account. So net, his loss was he bought at 410. He was assigned at 410, sold at 350, 500 shares, he lost $30,000. So let's look at how to avoid it. Close it before expiration. So if the stock was at 418 on September 4th, the put spread would have been trading at a very low value. Should have just closed it. And that is why I'm not comfortable with, letting these shares, which are very volatile, go all the way into expiration. But if you let it go into expiration, make sure you're monitoring your screen. And if you know that it is fallen below 410, it will be exercised. You should have reached out to your broker and say, exercise my 209 long put. In that case, his loss would have been just $500. But he didn't know, he wasn't monitoring the market. He didn't know that the Tesla has fallen to 390, after hours. So that's a sad story, but it teaches a very important lesson. So let me look at a question. So with this, we are end of today's session. Sorry, took 10 more additional minutes, but I really wanted to share this. Before you go and do put spreads, thinking that my loss is limited, it is limited, but then you have to use the protection at, before it expires. So I see a question, wouldn't this broker use his long put to automatically exercise at 2:15 p.m.? What I heard is Interactive Broker does automatic exercise, but not all brokers do. We reached out to TD Ameritrade. I don't think TD Ameritrade does it automatically. So don't depend on your broker. Talk to your broker. Say if this happens, what's the situation? Will they automatically exercise it? Or you need to send them an exercise, option exercise notification. Best thing is don't even depend on brokers. Why don't you close your short put before expiration? So I see a question. If the stock went down to 383 before expiration, maybe like a few days before expiration, is that okay? That would have been okay, because if it is before expiration, that person still has the long put, right? So instead of, let's say, taking an example of 410, 49, because I don't have those strike price, let's take an example of 560 and 555, right? I sold this short put. Oops. Okay. Now before expiration, if it has gone below, first of all, he may or may not be exercised. That depend on how much is extrinsic value left. We're not spoken about it till now, so I'm not going to delve detail into it. But before expiration, he still have, I still have this 555 lakh. Say if I get assigned before expiration, I get assigned stock at 560, it's fine. I still have time till 19th February to sell it back at 555. So if I get assigned at 550, 560, my account cannot hold this, I will exercise my put option to sell it at 555. So that would have been okay. Though the only issue was that it happened after market. So he did not know. Broker doesn't do auto exercise. He wasn't watching it. And the protection leg that he had already expired, because the exchange rules are that you have to send an exercise notice before 2:30 p.m. Your broker might have an earlier cutoff. So you need to check by when you have to send an exercise notice. Best thing the trader should have done, should have closed his short put before reaching expiration. In my years of trading, I never had to call my broker for exercising it, because I don't let my short put go all the way into expiration. It would have been trading in 2 pennies, 3 pennies. Why take that risk? Just close it off. 2, 3 pennies doesn't matter. 5 pennies won't matter. Just close it off. Close out your short put. Take the risk off the table. That would be the best best step in this for such situations.